Imagine waking up, tomorrow morning. You pour your coffee, you pull out your phone to check the financial news, and you find out that an entire modern industrialized nation's stock market has basically mutated.
Mutated into a leveraged ETF, essentially.
Exactly, a
Yeah.
leveraged exchange-traded fund. And not just any ETF, but one tracking a single wildly volatile technology trend.
Right.
So you're sitting there looking at your screen and you realize that the economic stability of the world's 13th largest economy is now entirely held hostage by the quarterly guidance of a couple of chip manufacturers that are thousands of miles away.
Which sounds completely absurd.
It sounds like dystopian fiction. But, I mean, that is exactly what you and millions of other people witnessed in July 2026 when South Korea's KSPI index just suffered its absolute worst single-session crash in years.
Yeah, it was a brutal morning for anyone watching the Asian markets, for sure. But I actually think it serves as the perfect entry point for what we're interrogating today.
I agree. Because today's deep dive into our source material, it isn't just a recap of market news. We are launching into a very serious, research-driven autopsy of the AI capital cycle.
Right, we've got a massive stack of institutional research sitting right here.
Literally a stack. I mean, we're pulling data from the Bank for International Settlements, the BIS, the OECD, Stanford's Human-Centered AI Institute, the IMF, plus just dozens of company filings.
And our mission with all this data is really to answer a central, basically a multi-trillion-dollar question, right? With all these hundreds of billions of dollars physically flowing into AI infrastructure, where does the value actually accumulate? Like, who actually captures it?
And, well, will the capital being committed today generate any proportional returns, or are we just, building a massive bonfire of investor cash?
Which is the defining economic question of this decade. I mean, as we look through these OECD reports
Yeah.
and these MBUR working papers, there's this core tension that just keeps emerging. And it's a tension we've seen play out in financial history before, where technology can genuinely transform the global economy. It can completely rewrite how human beings live and work, while at the exact same time producing just catastrophic financial returns for the investors who built it.
The technological success of AI, it does not guarantee its investment success.
Exactly. Those are two very different things.
And I want you, the listener, to really keep that distinction in mind as we go through this today. Technological success versus investment success. So to figure out how this all plays out, let's start with the canary in the AI coal mine. Let's go back to that July 2026 crash in South Korea.
Yeah, let's unpack that.
The numbers here are just staggering.
Yeah.
So July 28th, the KOSPI plunged 10.8%.
Which is massive for an entire index.
Huge. And that drop was so violent and so fast that it actually triggered a 20-minute circuit breaker. It halted all trading across the entire exchange.
Right. And for context, a circuit breaker is literally a mechanism designed to stop pure panic.
Yeah.
It just pulls the plug to force human beings and, algorithmic trading bots to just take a breath.
Right, to stop the free fall. But in this case, the panic was completely real. And if you look at the drivers of that panic, it was hyper-concentrated. You had Samsung Electronics falling 13.4% in a single session.
Just brutal.
And SK Hynix fell 14.7%. According to a research dossier here, these two stocks, they were already down like 30% to 40% from their 2026 highs before that single-day wipeout even happened.
Right. And the sheer structural fragility that this event exposed, that is what caught the attention of the macroeconomists over at the IMF. You really have to understand the composition of the South Korean market to get why this happened.
Explain that a bit, yeah.
So Samsung and SK Hynix, they don't just exist on the KOSPI for all intent and intents purposes. They kind of are the KOSPI.
Right, they dominate it.
They control nearly half of the index's total weight.
Mm-hmm.
And both of these companies just happen to be the primary global suppliers of advanced memory chips, specifically high bandwidth memory, or HBM.
Which we will definitely talk more about later because it's so important.
Yeah, we have to, because HBM is strictly required for AI accelerators to function at all.
So basically, because of that extreme concentration, the entire financial system of South Korea effectively became a derivative of global AI sentiment. And when that sentiment fractured, the market didn't just experience a normal correction, it literally broke.
It broke because the underlying mechanics were just completely overwhelmed. And the crazy part is, the triggers for this sell-off were actually quite far removed from Seoul.
Right, they were external.
Yeah, we had a guidance miss from Broadcom over in the U.S., meaning, they projected slightly lower future revenue than Wall Street was hoping for.
Okay.
And at the same time, There were these rising intelligence reports that Chinese domestic lithography equipment was advancing way faster than anyone anticipated.
Which is a huge threat.
Massive threat to SK Hynix's long-term manufacturing footprint in that region.
But, I mean, a guidance miss in California and a factory report out of China, that shouldn't instantly vaporize a tenth of South Korea's wealth.
No, it shouldn't.
What turned it from a bad news day into a historic crash was leverage. And the dossier details this just massive wave of forced selling. You had retail investors who had borrowed heavily. They were taking out margin loans from their brokerages just to ride this AI wave.
Right.
And if you're a listener who has ever traded on margin, you know the exact anxiety I'm talking about. You borrow money to buy more stock. If the price drops below a certain threshold, your broker issues a margin call. You either have to deposit cash immediately or they just forcibly sell your shares to cover the debt.
And the problem is, when everyone gets that margin call notification on their phone at the exact same time, the brokers are automatically dumping millions of shares onto the open market.
Just flooding the market.
Flooding it at whatever the market price is. So the bid-ask spread collapses. That massive wave of selling drives the price down even further.
Which triggers the next wave of margin calls.
Exactly. For the people who had slightly lower thresholds, it's just a cascading mechanical failure of the financial plumbing.
It really makes me think of like a massive company town, but on a national scale. You know, you have a town where absolutely everyone works at the local steel mill. The grocery store relies on the steel workers. The local banks lend to the steel workers.
Right.
And if the mill misses a quarterly projection and lays off 10% of the staff, the entire town's economy just freezes up. But I do want to push back on what this actually signifies for AI itself.
Okay, let's hear it.
Because when I read through these BIS reports on the crash, I find myself asking, does an event like this mean the AI boom is fundamentally a mirage? Or does it just mean that the financial piping was clogged with too much retail debt?
Well, that is the critical distinction we have to make, and it's exactly why the institutional research is so careful to separate the two concepts.
Huh.
The KOSPI crash, it tells us a lot about leverage, about greed, and about market mechanics. But to answer whether the underlying boom is a mirage, we really have to separate the actual physical utility of the technology from the speculative frenzy that's funding it.
Right.
If we zoom out and look at economic history, this dynamic where the financial infrastructure overloads and collapses while the technology itself just continues to mature and integrate, that is entirely consistent with past revolutions.
Yeah, the dossier actually leans heavily into these historical analogs, and I think it's really crucial we walk through them so you, the listener, have a solid mental model for what might be happening right now.
Yeah, the historical context is fascinating.
It really is. So we're looking at things like the British Railway Mania of the 1840s, the telecom fiber glut of the late 1990s, and, of course, the dot-com bubble from around 1997 to 2002.
Right.
And just to ground us in the sheer scale of the capital destruction there, look at the dot-com stats from the NBER data we have. The NASDAQ rose 400% during that run-up, entirely fueled by the promise of the internet. And then it fell 78%, which wiped out $5 trillion in market cap.
$5 trillion just evaporated.
That's hard to even wrap your head around.
It is. And to understand why that happens, the Stanford HAI reports we're looking at, they frequently reference the Schumpeterian framework and Carlota Perez's theory of technological revolutions.
Yeah, let's break that down for the listener. What actually happens in that framework? What is the installation phase?
So Perez argues that every major technological shift passes through this exuberant installation phase. During installation, a new technology, and doesn't matter if it's steam power or the microchip or neural networks, it creates genuine, undeniable economic optionality.
People can clearly see it's going to change the world.
Exactly. The problem, though, is massive valuation uncertainty. Because no one knows exactly how the new economy will be structured, right? We don't know who the winners will be or what the actual business models will look like. And because of that uncertainty, financial capital just rushes in blindly. Investors throw money at absolutely everything, which creates a massive bubble.
So it's basically the throw spaghetti at the wall and see what sticks phase, but with hundreds of billions of dollars.
Yes. And the core lesson from the telecom and dot-com eras is that this blind rush results in massive overbuilding.
Right, the fiber-optic cables.
Yeah. In the late 90s, telecom companies laid millions of miles of fiber-optic cables across the ocean floors because they were anticipating this just infinite, immediate surge in internet traffic.
But the traffic wasn't there yet.
It didn't materialize fast enough to pay off the massive debt they took on to lay the cables in the first place. So you had these spectacular bankruptcies, like Global Crossing, where billions in investor capital were just entirely wiped out.
And here is where it gets deeply counterintuitive. And honestly, this is what blew my mind when reading through the OECD's historical analysis that financially ruinous overbuilding was terrible for the initial investors, obviously, but it was actually a massive gift to society.
Oh, absolutely.
Because after Global Crossing went bankrupt, those physical fiber optic cables, they were still sitting at the bottom of the ocean. They didn't just disappear because the company folded.
Exactly. They were bought up in bankruptcy court for pennies on the dollar by new companies. And because the initial infrastructure capital costs were already written off by the people who went bankrupt, the cost of transmitting data plummeted to near zero.
Wow.
And that cheap, ubiquitous dark fiber, that is exactly what later enabled bandwidth-heavy innovations like YouTube or Netflix streaming, and really the modern cloud computing era. The first investors lost their shirts, but society got the infrastructure for almost nothing.
It's such a powerful mental model. You can build something socially and economically vital like the railways across Britain or the global telecom networks and still go completely bankrupt doing it.
Yep.
I keep picturing someone building a billion-dollar bridge. You know, they take out massive loans, they pour the concrete, they lay the steel, but when they open it, they only collect like $10,000 a year in tolls. The bridge is real. People drive over it every single day to get to work. It boosts the local economy. But the person who built it, their wallet is completely empty because the math simply doesn't work for them.
That is the perfect analogy.
Yeah.
That is the deadweight loss of the installation phase. The capital destruction suffered by the first wave of investors actually becomes the permanent subsidy that allows the next generation of applications to flourish.
That's a great way to put it.
So if we apply this to the AI capital cycle we're in now, the question isn't whether artificial intelligence will survive or be useful. I mean, it absolutely will be.
Right.
The question we are interrogating today is whether capital is being allocated at prices that future cash flows can mathematically justify.
Which means we need to follow the money. To figure out who gets left holding the bag this time, we have to map out exactly where these hundreds of billions of dollars are physically going in the current AI value chain.
We have to break it down.
Yeah, we can't just treat AI as one homogeneous industry. We have to start at the absolute bedrock, which is the silicon, the physical hardware.
Right.
And our sources break the hardware layer down into foundries, memory, and equipment. Let's start with the foundries, the places where these chips are actually printed.
This is where it gets wild.
It does, because the data on TSMC, the Taiwan Semiconductor Manufacturing Company, is honestly hard to wrap your head around. They hold a staggering 69.9% market share in foundry capacity.
Nearly 70%.
And Samsung is in second place with just 7.2%. I mean, TSMC is essentially a single point of failure for the entire global AI supply chain.
It is the ultimate choke point. If you are designing an advanced AI chip today, and it doesn't matter if you are NVIDIA designing GPU or AMD or even Google designing a custom tensor processing unit, you are merely sending a blueprint.
You just have the design.
Exactly. You still need TSMC to physically manufacture it.
Hmm.
And the reason for TSMC's dominance, it isn't just that they went out and bought the most expensive machines from ASML, is about something called yield management.
Okay, let's unpack yield management for the listener, because the physics of this are just fascinating.
They really are.
Yeah.
So when you are printing silicon at the nanometer scale,
Yeah.
and we are talking about transistors that are just a few atoms wide, the physics are incredibly unforgiving.
Right.
A single speck of dust, a microscopic vibration in the floor of the factory,
Yeah.
or a tiny fluctuation in temperature, it can ruin an entire silicon wafer.
Just instantly ruined.
Yeah. So yield refers to the percentage of chips on a wafer that actually work perfectly at the end of the process. If your yield is low, you are throwing away millions of dollars of raw material and machine time.
So it's essentially the ultimate manufacturing dark art. It's not just following an instruction manual.
Not at all. It is decades of accumulated tacit knowledge. TSMC has ecosystem trust. When NVIDIA hands them a chip design that costs, say, $500 million in R&D just to develop, they have 95% confidence in first-pass silicon success with TSMC.
Wow.
And look at Samsung. Samsung theoretically has highly competitive technology. Their new 2-nanometer gate-all-around architecture, it looks incredible on paper. But TSMC's operational discipline and their manufacturing precision on the actual factory floor, it has completely neutralized Samsung's theoretical advantages in practice.
And while TSMC totally dominates the logic chips, the brains of the operation, there is a hidden oligopoly that doesn't get nearly as much public attention as NVIDIA's GPUs.
The memory market.
Yes, memory. Specifically, high bandwidth memory, or HBM. Every single AI accelerator requires HBM. Standard computer memory just isn't fast enough.
No, it bottlenecks the whole system.
Right. HBM provides 5 to 10 times the bandwidth, which is strictly necessary because these massive AI models, they need to shuttle terabytes of data back and forth instantaneously just to calculate probabilities.
Memory bottlenecking is the primary constraint on AI speed. I mean, you can have the fastest GPU in the world, but if it has to wait for data to arrive from the memory bank, it just sits there idle.
Doing nothing.
Exactly. HBM solves this. But the HBM market is controlled by just 3 players globally: SK Hynix, Samsung, and Micron.
And the research refers to it as an impenetrable oligopoly. But, if there's so much money flowing into AI, why hasn't a startup just jumped in to disrupt them? Why aren't there 10 new memory companies?
Because the barriers to entry are physical, and they are astronomical. You don't just need advanced DRAM fabrication facilities, which cost tens of billions of dollars on their own. You also need incredibly complex packaging capabilities.
Packaging.
Yeah, the core technology in HBM is something called a through-silicon via, or TSV.
I saw that acronym all over the dossier. What is a through-silicon via in plain English?
Okay, so instead of laying memory chips out flat on a green motherboard, which takes up a lot of horizontal space and increases the physical distance the electrical signals have to travel,
Right.
HBM stacks the memory chips vertically, like a skyscraper. And a through-silicon via is literally a microscopic vertical shaft that is etched completely through the silicon wafer and then filled with copper to connect the bottom chip to the top chip.
Oh, wow.
Yeah, you are punching millions of microscopic holes through highly fragile silicon and stacking them with micron-level precision. And SK Hynix established their early dominance here by mastering this exact stacking process, and they secured NVIDIA's qualification first.
Which is huge.
Just everything. That left Samsung and Micron fighting over the remaining crumbs of the high-end market.
Which brings us back to Samsung, and it perfectly explains their reaction. Because if you look at the corporate filings in our dossier, Samsung announced a historic $73 billion semiconductor investment for the year 2026 alone.
It's an unfathomable amount of money.
Let me just repeat that for the listener.
Yes.
$73 billion in a single year. That is a 128% increase from their 2025 capital expenditure. It is actually the largest single-year semiconductor investment by any company in human history.
Yeah.
And they are pouring this money into the Yongin mega cluster in South Korea. They're pushing development of next-generation HBM4 memory, and they are trying desperately to close the gap with TSMC and SK Hynix.
And you have to look at what that $73 billion number implies about the competitive reality they're facing. Samsung is an incredibly disciplined company.
They don't just throw money away.
Exactly. They aren't throwing that much capital in a single year on a whim. They are doing it because the opportunity cost of losing the AI memory war is existential for their foundry business. If they cannot supply the memory, they lose the entire packaging contract, period.
And on the other side of this hardware equation, you have the company designing the chips. NVIDIA. Look at the 2026 realities for NVIDIA in this dossier. They are pulling in $216 billion in revenue with $130 billion in operating income.
The margins are just absurd.
Unheard of for hardware. And the market is valuing them at 35 times forward earnings. But what does it actually take to justify that valuation mathematically?
Well, this is where the Goldman Sachs and Bain advisory research gets very sobering very quickly. To justify a 35x multiple on that massive revenue base, standard discounted cash flow models dictate that NVIDIA's data center revenue must continue to grow at 35% to 45% annually through 2027.
Wait, 35 to 45% growth on top of $216 billion?
Yes, all while maintaining gross margins above 70%.
That's wild.
The market is pricing in absolute perfection for the next several years.
But wait, let's inject some common sense here. If absolutely everyone, Samsung, TSMC, Intel, SK Hynix, if they are all building massive new fabrication plants and throwing historic amounts of capital at increasing capacity, aren't we just aggressively accelerating toward a brutal supply glut?
Yes.
I mean, at what point does essential AI infrastructure stop being a scarce resource and just become commodity hardware? We literally just talked about telecom fiber. Once the fiber was laid, the price of transmitting data plummeted, right? The price of AI compute do the exact same thing once all these factories come online?
That is the exact risk the OECD and financial analysts are monitoring right now, and it's the core thesis of the bear case. Hardware is fundamentally cyclical. History suggests that when multiple heavily capitalized players try to capture the same monopoly rents at the exact same time, they inevitably overbuild.
Right.
Let's say the transition from training massive new AI models to simply running inference on existing models requires less top-tier memory than currently projected. Or let's say the overall pace of AI investment decelerates, even slightly.
Just a little bit.
Suddenly, Samsung and others could find themselves with massive overcapacity. They will have to slash prices just to keep their factories running, which severely compresses margins on that $73 billion investment they just made.
Which leads us directly to the next layer of the stack, because hardware is essentially just a rock that we tripped into thinking with electricity.
That's a good way to put it.
Right. It is only as valuable as the software running on it. So the multi-trillion-dollar question becomes, who is actually buying all this silicon, and can their underlying business models actually support the cost?
Right.
And to answer that, we have to look at the economics of the frontier model labs, the places actually building the AI. And our dossier gives us a stark, just fascinating tale of two very different labs in 2026, OpenAI and Anthropic.
The divergence in strategy and financial health between these two companies in 2026, it's probably the most revealing indicator of where AI value is actually accumulating in the software layer. Let's look at Anthropic first.
Okay.
By early 2026, Anthropic reached a $30 billion annualized revenue run rate. They reportedly overtook OpenAI in annualized revenue terms by the second quarter.
Which is huge on its own, but what the dossier points out is the composition of that revenue. That's the key.
Yes.
85% of Anthropic's revenue is enterprise. They are selling directly to massive corporations who use the API to streamline legal review or coding or customer service. And because of that structural focus on B2B, they expect a Q2 2026 operating profit of $559 million. And they're projecting 77% gross margins by 2028.
When a financial analyst looks at Anthropic's numbers, they see software economics.
It makes sense to them.
Right. It looks like a traditional, healthy software as a service or SaaS business. The high initial R&D costs are offset because the marginal cost of serving an enterprise client is relatively low compared to the massive subscription fee they're paying.
Now, I want you to hold that picture of a healthy enterprise business in your mind, and let's compare it to OpenAI. Yes, OpenAI grew at a rate that shattered every historical precedent. They went from $2 billion in revenue in 2023 to $20 billion in 2025.
Unprecedented growth.
Truly, they pulled in $5.7 billion in just the first quarter of 2026. But they are burdened by absolutely staggering costs because 85% of OpenAI's revenue is tied to consumer subscriptions, the $20 a month ChatGPT Plus tier.
Right.
And they have a massive free tier. 95% of their user base is paying absolutely nothing.
And those free users are not actually free for OpenAI.
Yeah.
This brings us to what the industry is calling the gross margin problem. OpenAI's gross margins actually deteriorated, falling from 40% to 33% in 2025.
Let's make sure everyone understands why that happens, because in traditional software, adding a new free user costs almost nothing. If I download a free weather app, the server cost to send me the weather is a fraction of a cent. So why is AI different?
Because of inference costs. In AI, there are two phases of compute, training and inference. Training is the massive one-time cost to build the model running thousands of GPUs for months to basically read the internet.
Right.
But inference is the cost of actually using the model. Every single time a user types a prompt into ChatGPT, a cluster of GPUs in a data center has to physically spin up, perform billions of mathematical calculations in real time, and generate the response.
This is more like running a taxi service than selling a CD. Every single trip costs gas.
That's exactly it. When you have a massive base of free consumers treating ChatGPT like a search engine, your compute costs scale linearly with usage, but your revenue remains flat.
Oh, wow.
Yeah, so the more successful your free product is, the more money you lose. Which is why the future projections for OpenAI in this dossier are genuinely terrifying. Their projected computing expenditures are slated to hit $121 billion in 2028 alone.
Just on compute.
Just on compute, which leads to a projected operating loss of $74 billion that same year.
$74 billion in losses in 1 year.
I mean, let's really unpack the structural paradox here, because this is where the entire ecosystem looks incredibly fragile. Both OpenAI and Anthropic are trying to build the most expensive software businesses in human history,
Right.
but they are building them on compute infrastructure that they are renting from Microsoft, Amazon, and Google. These cloud providers, the hyperscalers, they're simultaneously their biggest investors, their primary infrastructure providers, their customers, and their direct competitors.
It is a profoundly conflicted value chain.
It's like you are trying to run a wildly successful Michelin star restaurant,
Right.
but your landlord is also your biggest venture capital investor.
Right.
They eat at your best tables for free. And by the way, they are actively studying your menu to open a replica of your exact restaurant right next door using the rent money you pay them. I mean, how can a frontier lab possibly build defensible moat in that scenario? It is deeply precarious, and it touches on the fundamental flaw in the capital cycle. The frontier labs do not own their own compute. The hyperscalers, the landlords, in your analogy, they enjoy all the scale efficiencies and the high guaranteed margins of selling the physical infrastructure.
Yeah.
The frontier labs, on the other hand, they're caught in this vicious margin war. They are paying astronomical fees for compute out the back door, while facing severe downward pricing pressure on their models out the front door.
And that downward pricing pressure is getting intense, especially with the introduction of models like DeepSeek, which the dossier specifically highlights as a major disruption. I want to spend a minute here.
Yeah, DeepSeek changed a lot.
It really did.
Yeah.
Everyone in the U.S. assumed the path to better AI was just brute force. Buy more NVIDIA chips, build bigger data centers, train larger models, and then DeepSeek, a Chinese lab, comes out of nowhere and proves you can get frontier-level intelligence using a fraction of the compute power through radical efficiency and model distillation.
DeepSeek fundamentally challenged the bigger is always better scaling laws. If sufficiently capable intelligence becomes dramatically cheaper to train and run, rather than simply larger and more complex, the economics of the entire stack flip.
It changes everything.
It does. For the end user, it's fantastic, Harry. AI becomes cheap and ubiquitous. But for the frontier labs who just spent $10 billion training a massive model, their product is suddenly commoditized. And for NVIDIA, if training and inference require less heavy iron, their total addressable market shrinks.
It's the ultimate deflationary force. So the thesis for OpenAI's sky-high valuation rests on the idea that autonomous AI agents will eventually become the structural interface for all computing.
Right, that we won't use apps anymore.
Exactly, that we will just talk to AI instead of using operating systems, and that this will eventually justify these massive near-term losses. But as the gap between Anthropic's enterprise profitability and OpenAI's consumer cash burn widens, public markets are going to fiercely scrutinize that thesis.
They already are. And it brings up what I think is the most urgent question in the entire dossier.
Which is, how are these massive compute costs actually being funded?
Exactly.
If OpenAI needs $121 billion for compute in a single year, and they are losing $74 billion, where's that physical cash coming from? They can't just put it on a corporate credit card.
No, they cannot.
The answer, according to the tracking done by the Bank for International Settlements and Bloomberg, lies in a deeply tangled web of hyperscaler balance sheets and global debt markets. We are entering the realm of the circular capital loop.
To understand the loop, we really have to look at the macro numbers first. The hyperscalers, Microsoft, Amazon, Google, Meta, they have collectively committed over $700 billion to an AI infrastructure buildout.
$700 billion.
It is a historically unprecedented reallocation of corporate capital. To put it in perspective, their capital intensity, which is the percentage of their total revenue they are throwing right back into capital expenditure, it is hitting 45% to 57%.
So half of every dollar they make.
Half of every dollar Google or Microsoft makes is going straight into data centers and chips. But what the BIS is tracking with increasing alarm is how this capital actually flows. They call it circular financing.
Let me give you an example from the dossier that perfectly illustrates this, because it sounds crazy until you actually trace the dollars.
It really does.
So AMD, the major chip manufacturer, gives OpenAI a warrant, essentially an option to buy 160 million AMD shares. In return, OpenAI commits to deploying 6 gigawatts of AMD GPUs in their data centers.
Right.
Now, if you just read the press release, it looks like a massive commercial win for AMD. They secured a huge customer. But the demand from OpenAI is intimately tied to the equity and the financing that AMD itself is providing.
It's entirely circular, and you see this everywhere in the ecosystem. Hyperscalers take massive equity stakes in AI startups. Those startups immediately turn around and use that exact same investment money to commit to multi-year purchases of cloud compute from that exact same hyperscaler.
So they just buy each other's stuff.
Yes. The hyperscaler gets to record the cloud compute as revenue, making their growth look incredible, but the money actually originated from their own balance sheet.
But eventually, someone has to pay for the physical concrete and the electricity of these data centers. How do the hyperscalers manage this without destroying their own stock prices?
By pushing this massive capital expenditure into the debt markets, the hyperscalers issued over $100 billion in gross corporate bonds in 2025 alone. Furthermore, the BIS notes that financing is increasingly shifting to off-balance sheet structures called special purpose vehicles, or SPVs.
Hold on, stop there. For the listener who isn't an accountant, what actually is an SPV and why is it dangerous in this context?
Okay, let's say a tech giant wants to build a $5 billion data center, but they don't want that $5 billion liability sitting on their quarterly earnings report because it would scare investors.
Right, makes them look less profitable.
Exactly. So they create a separate shell company, the SPV. They get a bank or a private equity firm to loan the SPV the $5 billion to build the data center. The tech giant then signs a long-term contract to lease the data center from the SPV, and they provide a corporate guarantee to backstop the debt.
So it keeps the debt off the tech giant's immediate balance sheet.
Well, yes, it obscures the immediate risk, but the risk doesn't vanish. It just transfers the systemic risk of this AI build-out directly into global credit markets. Banks and pension funds are holding the debt, assuming the tech giant's guarantee makes it completely safe.
I am looking at this loop and it feels deeply precarious. I mean, if the hardware vendors are financing their own customers to buy their equipment, aren't we just watching money move from the left pocket to the right pocket?
Essentially, yes.
Yes. At what point does real organic cash from outside the tech bubble actually enter this loop? If a Wall Street bank lends money to an SPV based on a guarantee from a hyperscaler who is relying on revenue from an AI startup, who is paying for it with venture capital money raised on the promise of future enterprise adoption, I mean, it feels like a house of cards waiting for a stiff breeze.
That is the exact vulnerability the IMF and BIS are warning about in these reports.
Yeah.
In a normal, healthy market transaction, a customer uses independently generated cash to buy a supplier's product. That is genuine end-user demand.
Right.
In the AI capital loop, it is incredibly difficult to separate independent demand from demand that is artificially propped up by the financing ecosystem itself.
So what happens if it breaks?
Well, if enterprise software customers do not ultimately adopt AI at a scale that generates hundreds of billions of dollars in net new software revenue, the cash flows at the end of the line will fall short. The debt, however, the lease payments on the data centers, the SPV, guarantees those remain fixed.
They still have to be paid.
Exactly. And if that mismatch occurs, credit spreads will widen globally, and the equity losses inside these tech companies will spill directly into the broader macroeconomy.
That is a chilling scenario. But while the private markets and tech giants are playing this high-stakes game of circular finance, we are actually seeing a completely different type of capital entering the fray.
The sovereign wealth.
Yes, because governments around the world have realized that AI isn't just, the next iPhone update or a cool software feature. It is a matter of fundamental national security and geopolitical dominance. Which brings us to the role of sovereign capital and strategic risk.
And the entrance of the state changes the economic calculus entirely. We have to separate private capital from sovereign capital. Private capital, whether it's venture capital or public markets, is ultimately accountable to return on investment.
Right.
It needs to see a path to profitability, usually on a relatively short timeline of, say, 3 to 7 years. State capital behaves completely differently. It acts as patient capital.
Patient capital. Explain that.
It can fund foundational research and development that might not commercialize for a decade, or maybe never turn a direct profit, but is deemed strategically vital for national survival.
I want to look at the U.S. federal government's AI funding here because the dossier highlights a massive discrepancy. The numbers are a bit shocking when compared to the private sector. The National Security Commission on AI, the NSCAI, they set a $32 billion spending target to keep the U.S. competitive. But currently, non-defense AI R&D in the U.S. is hovering around just $3 billion.
Which is a rounding error compared to Microsoft's budget.
Exactly. And because of that underfunding, you have massive, ambitious public moonshots that are essentially starving. The Department of Energy has this program called Fast Frontiers in Artificial Intelligence for Security, Science, and Technology.
Right, the DOE program.
Yeah, they need about $2.4 billion a year. Their goal is to build proprietary, highly secure foundational models for things like energy grid management, nuclear stockpile simulation, and biosecurity modeling. But they can't get the funding. And the National Science Foundation's AIR pilot, which is supposed to democratize compute access, so researchers outside of Google and Meta can actually study AI, they are struggling to get their requested budget.
Contrast that underfunding in the U.S. public sector with what is happening globally, particularly in Asia.
Mhm.
We already discussed Samsung's $73 billion investment.
Right.
The South Korean government isn't just watching that happen, they are actively supporting that youngin cluster with aggressive tax incentives, water and power infrastructure development, and streamlined permitting. Why? Because semiconductor exports account for 20% of their entire national exports. It is quite literally the bedrock of their economic security.
And China is playing an entirely different game, too.
Oh, absolutely. China is aggressively subsidizing computing power at the municipal and provincial levels. They are providing state-backed data provisions. They are treating AI infrastructure as a national utility, much like highways or the electrical grid.
Wow.
They are not waiting for private venture capital to decide if a model is profitable. They are funding it because it is strategically necessary. We also see Gulf sovereign wealth funds deploying massive capital to build localized compute clusters to diversify away from oil.
Okay, I hear all of this, but I have to ask the obvious skeptical question on behalf of the taxpayer here. If Microsoft, Google, Meta, and Amazon are collectively spending $700 billion on AI infrastructure in the United States, why does the U.S. government need to scrape together $32 billion?
It's a fair question.
I mean, what exactly does that public money buy that the hyperscalers aren't already building? Doesn't the U.S. already have a massive lead because of big tech?
It comes down to incentives. Public money buys strategic independence and fundamental science. The hyperscalers are optimizing for commercial AI. They want large language models that can write Python code or draft marketing emails and serve highly targeted ads.
Right.
They are not incentivized to build a 247 national medical shield to model global biothreats in real time. They are not designing AI specifically to manage the nuclear stockpile.
Because there is no recurring SaaS revenue in biothreat modeling.
Exactly. Relying purely on the private sector's circular financing loop leaves massive structural gaps in national competitiveness. Furthermore, if the private market bubble bursts, if the hyperscalers suddenly cut their capex to preserve their operating margins during a recession, a nation without a robust public R&D infrastructure will instantly fall behind adversaries who are using state-directed patient industrial policy.
So state involvement proves that the underlying technology is strategically vital, regardless of the short-term financial returns. It is the new space race.
It really is.
But as we look back at those private markets and, the everyday investor who is buying tech ETFs in their retirement account, we have to ask if the current valuations are in any way tethered to economic reality. Let's dig into the valuation puzzle and the macro reality. We've got this great conceptual framework in the research from NYU professor Scott Galloway. He compares Anthropic to Walmart.
It is a brilliantly clarifying comparison to really ground us in physical reality. Let's look at Walmart. Walmart is a mature, highly optimized, incredibly complex global business.
Right.
They generate around $675 billion in net sales every year. After all their expenses, they make about $30 billion in actual operating profit, and the public market values the entire company at roughly $1 trillion.
Okay, so $675 billion in revenue, $30 billion in profit, $1 trillion valuation. Got it. Now look at Anthropic in 2026.
Anthropic in early 2026 is valued at nearly $900 billion pre-money. Their valuation is approaching Walmart's. But Anthropic is only generating a $30 billion revenue run rate. They're burning $14 billion a year in compute and talent costs. And they admit they won't see positive free cash flow until 2028 at the earliest.
So how does that math possibly work for an investor? Why would you value a cash-burning software startup the same as the largest retailer on Earth?
Galloway introduces this three-line shareholder value framework to explain the psychology here. Imagine three horizontal lines. At the top, you have perceived value. In the middle, you have price. At the bottom, you have cost.
Okay.
Shareholder value is the gap between them. Walmart creates value by relentlessly pushing the bottom line cost down through massive supply chain scale and pulling the middle line price down for consumers, capturing huge volume.
But Anthropic can't push their costs down because they are paying TSMC and NVIDIA and Amazon massive premiums for compute.
Right. So Anthropic's valuation rests entirely on pushing that top-line perceived value into the stratosphere. The multiple on Anthropic isn't based on their current $30 billion run rate. It is based on the promise of an infinite total addressable market, or TAM.
An infinite TAM.
The bet is that AI, as a pure software business, will eventually consume every white-collar job, every customer service interaction, every line of code written globally. The investors are betting that once the models are fully trained, Anthropic will convert all that revenue into massive 80% software-like margins.
But this is where the macroeconomic data introduces a severe, just ice-cold reality check, and this is the part of the dossier that I found most alarming.
The GDP numbers.
Yes. According to joint data from the International Energy Agency and the Bureau of Economic Analysis, ICT, investment information and communication technology, has hit 5.5% of the entire U.S. GDP.
To put that in context, that is a higher percentage of the national economy than we saw during the absolute peak of the dot-com bubble.
5.5% of the GDP is going into tech infrastructure. And yet, what is the actual tangible payoff for the broader economy? The dossier includes a meta-analysis of macroeconomic productivity gain estimates from AI. You know, how much more efficient is the average worker actually getting?
Right.
And the estimates from economists, they range wildly. You have some saying we will see 0% gain, some saying an incredibly optimistic 3.5%, but the average consensus among these institutions is sitting around a mere 1% bump to long-term productivity.
This is the fundamental tension of the entire AI capital cycle. It is the clash between microeconomic expectations and macroeconomic reality.
Yeah.
If capital markets are pricing in a complete economic revolution, an infinite TAM justifying a $900 billion valuation for Anthropic, but the actual aggregate productivity data only delivers a 1% macroeconomic bump, there will be a violent reconciliation.
The math simply doesn't square.
It doesn't. The risk for everyday investors is that if productivity gains prove insufficient to justify 5.5% of the GDP being poured into server racks and cooling systems, the market will aggressively reprice growth expectations. And when expectations reprice, those astronomical multiples come crashing down. Let's make that tangible for the listener, away from the macro theory. Let's look at a specific product, Microsoft's Copilot model.
Good example.
Henry Fund Research points out that Microsoft has spent so much money on AI infrastructure that they need 7% to 10% paid Copilot penetration across their massive global user base just to break even on their CapEx, meaning 1 in 10 Office users needs to pay an extra $30 a month forever.
And this tests the difference between technical capability and economic deployment. Technically, Copilot is amazing. It can summarize your emails and draft spreadsheets.
It's very cool.
But economically, an enterprise CTO has to look at their budget and ask, does summarizing emails actually generate $360 a year in hard value per employee? What happens if the enterprise customers do that ROI calculation and decide they just don't want to pay a $30 premium per user for AI-infused software? Does the whole house of cards come down?
Well, if the end-user monetization fails, the circular financing loop we discussed earlier runs out of oxygen.
Yeah.
The hyperscalers would have to absorb the depreciation of hundreds of billions of dollars in data center equipment without the corresponding software revenue.
Right.
Now, it wouldn't necessarily destroy Microsoft or Google their legacy search, and cloud businesses generate massive free cash flow that can absorb a lot of damage, but it would absolutely devastate the independent AI startups and the pure-play hardware suppliers whose valuations demand perpetual hypergrowth.
Which brings us to our final synthesis. We set out at the beginning of this deep dive to answer where the value actually accumulates in this AI capital cycle. And we've mapped out a landscape characterized by massive, historically unprecedented infrastructure spending at the hardware layer.
We've unpacked the fragile circular financing, keeping the loop moving through SPVs and debt.
Right. We've examined starkly different business models at the frontier between OpenAI and Anthropic, and the deflationary threat of models like DeepSeek. And we're looking at valuations that are priced for absolute perfection in a macro environment that expects merely a 1% productivity bump.
When you aggregate all of these sources, the bottom line on value capture requires us to remember the painful lessons of the telecom and dot-com crashes.
Yeah.
Survival and long-term profitability in a technological revolution do not depend on simply raising and spending peak capital. They depend on defensible positions, true network effects, proprietary data lock-in, and ruthlessly efficient cost structures.
So break it down layer by layer. Who captures the value?
The hardware layers, Samsung, SK Hynix, even NVIDIA, despite their current incredible margins, are highly vulnerable to commoditization and overcapacity if the capital cycle turns or if inference becomes dramatically cheaper.
Right.
And the frontier model labs are fighting a brutal existential margin war against the very infrastructure providers who host them, struggling to find consumer willingness to pay.
Here's a final thought to mull over as we wrap up this deep dive into the source material. There's a famous saying in finance, usually attributed to Keynes: the market can remain irrational longer than you can remain solvent.
A classic.
Usually that's a warning to short sellers who try to bet against a bubble. But in the context of this specific AI revolution, the dossier suggests a fascinating twist. Consider this. What if the hyperscalers are solvent enough to outlast the irrationality?
That is the ultimate strategic advantage in this cycle.
Yes. Think about it. Microsoft, Google, Amazon, Meta, they have the ability to self-fund this $700 billion build-out purely from the cash flow of their existing wildly profitable monopolies in search, e-commerce, and enterprise software.
Exactly.
They don't need the AI to be profitable tomorrow. They might just survive the massive capital destruction that will inevitably wipe out the independent AI startups who are burning venture capital with no legacy safety net.
It is entirely possible that the AI revolution happens, the world changes, millions of investors lose everything, and the only entities left standing are the four tech giants who had the balance sheets to absorb the deadweight loss at the installation phase.
So as you look at your own portfolio, or as you evaluate how your company is using AI, ask yourself, in a world where intelligence itself becomes incredibly cheap, ubiquitous, and commoditized, who actually wins? Is it the startup trying to sell you the intelligence for $20 a month? Or is it the incumbent giant that uses that cheap intelligence to sell you absolutely everything else? Keep questioning the narratives behind the numbers.